On the afternoon of July 29, 2026, the Federal Reserve announced that it was doing nothing. Rates unchanged, 3.5 to 3.75%, exactly where they were before. And then, over the next hour, while the chairman stood at a podium explaining that decision, the yield on the 30-year Treasury bond climbed from around 5.1% up to 5.21. It touched 5.244 that day, the highest it had been since July of 2007. The Dow closed down 1,153 points. The Fed did not move a single quarter point, and borrowing money got more expensive anyway. I want to be clear about what this video is and is not. I am not going to tell you where rates are going next. Nobody knows that, and anyone who says they do is selling something. What I want to do instead is explain something more basic, and honestly, something I did not fully understand myself until I sat down and read the entire transcript of that press conference. Here it is. The interest rate the Federal Reserve votes on and the interest rate on your mortgage are not the same thing. They are not even set in the same place. They are not even set by the same people. Most of us were taught to watch the Fed, and for one specific number, that is the wrong thing to watch. Start with what the Fed actually controls. The federal funds rate is an overnight rate. It is the cost for banks to borrow from each other for one single night. That is the lever. That is the thing that gets voted on. Your mortgage is 30 years. So how does a one-night rate turn into a 30-year rate? The honest answer is that it mostly doesn't. Something else does that job. Here is what happens after you sign a mortgage. Your bank almost never keeps it. Within a few months, that loan gets sold, usually to Fannie Mae or Freddie Mac, where it is bundled together with thousands of other loans into something called a mortgage-backed security, a bond. And that bond gets traded all day, every day, by investors. Which means the rate you were quoted was never really about your bank's opinion of you. It was about what investors in that market were willing to pay for the bond your loan was going to end up inside. That market is roughly $9 trillion, and it is open while you are asleep. Those investors price your loan off the long end of the Treasury curve, mostly the 10-year. As of August 3, 2026, the 10-year Treasury was at 4.70%, and the average 30-year mortgage was around 6.71. The gap between them, about 2.01 percentage points, is the spread. And that spread is not a constant. Between 2010 and 2020, it usually sat below 2 points, often closer to 1.5. In recent years, it has hovered around 2.5. It widens when interest rates get volatile, because volatility makes that bond harder to price, and investors charge for uncertainty. So read that spread for what it is. It is not a fee somebody decided to charge you. It is the price of the market not being sure what happens next. None of this means the Fed is irrelevant. It matters enormously, but it matters indirectly. The Fed sets tonight. The bond market prices the next 30 years based on what it believes the Fed will actually do over all of those years. Belief is the transmission mechanism, which is why what happened on July 29th is worth understanding. The vote was 9-3. 3 officials dissented, and all 3 wanted a hike. Lori Logan of the Dallas Fed, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis. That is the first time since September of 2016 that 3 policymakers dissented, pointing in the same direction. But the part that got much less attention is what Chairman Kevin Warsh said in his own opening statement. He brought up the bond market himself before anybody asked. He said that since the last meeting 42 days earlier, nominal and real yields were materially higher across the Treasury curve, and then he put a number on it. He said some of those increases in market interest rates between Fed meetings were, quote, among the most significant in the last 2 decades, ranking around the top decile or so. The top 10% in 20 years, between 2 meetings where the Fed did nothing. Later, a reporter asked him what he thought the market was telling him, and his answer is the sentence this entire video is built around. He said, quote, even while at some level we haven't done much in 42 days, the markets have done quite a bit. That is the chairman of the Federal Reserve saying, out loud, that the movement did not come from him. Now, most of the coverage that night framed this one way. Credibility crisis. The Fed is losing control of the long end. And there is real evidence for that reading, which I will get to. But if you read the whole transcript, you find something the headlines mostly skipped. Warsh was not describing a failure. He was describing a plan. In the same opening statement, He noted that the Fed had pulled back on forward guidance and suggested that reduction may have been a factor in the move. Then he said this: "Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit." And then, directly, "This is, in my view, a change for the better, and we are just getting started." He also said, "The central bank need not always and everywhere be the center of attention." Even the three dissents were deliberate. When a Financial Times reporter asked him about them, he said he had asked for a good family fight, and he got one. His words: "That's the purpose, that's the design feature." So this is not a story about someone dropping the wheel. It is a story about someone loosening their grip on purpose, and the bond market immediately filling the space. Whether that turns out to be wise is a genuinely open question, and not one I can settle for you. But it was a choice, and it is worth knowing it was a choice. Here is the part that connects all of it. A long-term interest rate is, underneath everything, a vote on inflation. When you lend money for 30 years, the thing that can quietly destroy you is inflation eating the value of every payment you get back. So the rate you demand is your honest estimate of that risk, plus compensation for being wrong. Warsh clearly understands that because he spent a large share of that press conference on exactly one theme. He said there is no soft inflation target, no soft implicit target, that there is only a target, and it is 2%. He said this Fed will not waver, and that its credibility rests on performing its duties. And then comes the strangest part of the whole day. Warsh was asked what the world made of it, and he pointed at the markets as evidence in his favor. He said if you looked at the Treasury curve and at the dollar, what they were broadly saying was that this committee owns it and has the credibility to deliver it. Meanwhile, Eric Winograd, chief U.S. economist at AllianceBernstein, wrote to clients that he thought the press conference was confusing and often internally contradictory, and investors did something genuinely contradictory in response. They lowered the odds of a hike at the next meeting, and they pushed long-term yields up at the same time. Same data. Two completely opposite readings. I'm not going to referee that. I do not think I can, and I do not think you need me to. Because here is the thing that is true under either interpretation. That number becomes the same bill. Whether the bond market was expressing confidence or expressing doubt, the yield went up, and the yield is what your loan is priced against. And there is one more piece, because it is not all about belief. Roughly half of July's sell-off in long-term treasuries came from a rising term premium. That is the extra compensation investors want, simply for locking money up for a long time. One of the things pushing it, according to market analysts, is the wave of debt that large technology companies are issuing to build AI data centers. All of that borrowing competes for the same pool of money your mortgage is drawing from. If this feels unprecedented, it is not. It happened before, and it ran the other way. Between June of 2004 and July of 2006, the Fed raised rates by 4.25 percentage points, 17 consecutive increases, and long-term yields did not follow. By one measure, the 10-year rose about 0.3 of a percentage point across that entire stretch. There was one window that was even stranger. From June 29, 2004 to February 2, 2005, the Fed raised rates by 150 basis points and the 10-year Treasury yield fell by 70. Alan Greenspan himself in 2005 called it a conundrum. That is the actual word, and it stuck. Researchers have spent 20 years on why. The leading explanation is a falling term premium. Other work argues that foreign buying of U.S. Treasuries explains more than half of the decline. Now hold those two pictures next to each other. In 2004, the Fed pressed the accelerator, and the market pressed the brake. In 2026, the Fed is sitting still, and the market pressed the accelerator on its own. Same mechanism, mirror image. And in both cases, the answer is the same. The long end was never taking orders. It was making an assessment. Go back further and it gets sharper. Under Arthur Burns in the 1970s, the Fed funds rate went from 9% down to 3.5%, up to 13%, back down to 5%, and up to 9% again. People watched an institution change direction roughly every 18 months, and they drew the obvious conclusion, which was that it would always flinch first. So inflation expectations grew legs. They got written into wage negotiations and price lists, and once that happens, the expectation does a lot of the work by itself. And here is the detail from the Volcker era that I think is genuinely underrated. What broke it was not purely the height of the rates. On October 6, 1979, the Fed changed its operating procedure to target non-borrowed reserves, and historians of that period read that mostly as a commitment signal, not a technical adjustment. It was a way of saying, we will not be able to quietly back out this time. Research on that disinflation suggests roughly half of it came from expectations re-anchoring, rather than from the tightening itself. Which means credibility was not a nice to have. Credibility was doing about half the work. So what did all of this actually cost, out here? Freddie Mac publishes a weekly survey. On July 30th, 2026, the average 30-year fixed mortgage was 6.66%, up from 6.58% the week before. And I want to be precise here, because a lot of coverage called that a one-year high, and that phrasing can mislead you. A year earlier it was 6.72%, slightly higher than today. So the accurate statement is that this was the highest since late July of 2025, not a record, not worse than last year. I am flagging that on purpose. If I round that in the scary direction once, nothing else I tell you is worth much. Now, one last thing about that transcript. It runs about 41,000 characters, 20 pages. I ran a word count on the whole thing. The word mortgage appears 0 times, housing 0, borrow 0. I want to be careful with that, because it would be easy and cheap to turn it into an accusation, and I don't think the accusation is fair. That room exists to discuss policy, not to read out loan quotes. But it does illustrate the actual point of this video. The pricing power moved to a place that does not use the word mortgage. The bond market speaks in yields, term premium, and duration. Your loan sits downstream of that curve, and downstream does not get mentioned by name. The final question that day came from Brian Chung of NBC News, and he essentially asked it on behalf of everyone watching. No rate change, no forward guidance. For the average household, he asked, what was the news today? So here is what I would take away from all of it. The next time you hear that the Fed held rates steady, that sentence is true, and it is also smaller than it sounds. The room that voted did not move. The place that actually prices your loan may have moved all week. That is not a conspiracy, and it is not a system breaking down. It is closer to the opposite. It is the system running the way it was built, with one part of it far more visible than the other. And the practical value of understanding that is simple. When the cost of borrowing shifts under you, you will know what it is. It is not a verdict on you. It is not somebody deciding you should pay more. It is the result of a vote you were never invited to, held in a market that never says your name, and mailed to your house anyway. The Fed sets tonight's rate. The bond market sets the next 30 years. Educational only, not financial advice. Thanks for watching.